If you already registered your LLC with the state, a good question to ask yourself is, how should I be filing my tax returns for my LLC? Let's take a look. So when you have an LLC, you have a couple of options. First of all, if it's a single member LLC, you would report your income on your Schedule C, just like a sole proprietor. So it's version 1 and 2 here, where there's really no difference. All the income of $150,000 is subject to self-employment tax, which is about $21,000. Also, the entire income generated by that LLC is considered for calculating qualified business income deduction, which is 20% of that net income that your business generated. In this case, almost $28,000. So then your net tax that you have to pay is your self-employment tax plus your income tax. I assumed here it's 20% effective tax rate at the federal level. So altogether, you're paying about $43,000 of taxes on $150,000 of net income. When it's an LLC and you established an LLC because you needed it for liability protection, not because you wanted to save on taxes, you are paying an additional LLC fee to some states. In California, it's $800. And then also there is a gross receipts tax. If your revenue is $250,000 or more, you'll pay an additional tax to the state. So in order to minimize self-employment taxes, we can also make an election called an S-Corporation election. There's no such thing as an S-Corporation. You can't go and register it an S-Corporation. You either register an LLC or register a regular corporation, and then you make an election to be taxed as an S-Corporation. So in this example, you have the same income of $150,000, but we're paying ourselves $80,000 of reasonable salary. Per the IRS code, we have to pay a reasonable salary to ourselves when we own an S-Corporation. And on that $80,000 of salary, the self-employment tax is about $12,000. So almost half of which you paid on the entire $150,000. So pretty big saving right here. However, your qualified business income deduction is decreased tremendously. Why? Because the entire income of $150,000 was decreased by the $80,000 salary that you paid to yourself, and only then the qualified business income deduction was calculated at 20% of whatever was left over. There's also an additional deduction that you possibly could have, which is the pass-through entity tax deduction, if you make that election to participate in that program. I had a recording last week, so please take a look at it and see if that applies to you. So in the example of the S-Corporation, the net tax is $37,000. You're paying more in income taxes. You're paying a 20% effective tax rate, about $25,000, but your self-employment tax is much lower. Soup to nuts, on the same amount of money, we're looking at about $5,000 of savings here. Now, does it make sense to jump through all the hoops to run payroll, to file additional tax returns, to pay your preparer to do so? It's your call. Another option is a C corporation. With the same amount of income and the same amount of salary, I say forget about it, because you're paying about $58,000 in taxes between federal and our state here, California. However, C Corps are not all that bad. For example, if you're planning on selling your business, potentially the entire gain from the sale of your C Corporation stock could be excluded from your taxable income. It's up to $15 million now. So if you sell your business for $15 million, and that's all the gain, you might not have to pay any tax on that gain. So super important to keep that in mind, because it's not just short-term planning. This is specifically referring to, can you save on taxes this year? But if you're looking into the future, maybe C Corp is the best route. Until next